The best ways to generate returns in the market is to invest regularly and consistently over long durations of time rather than timing the market. But there are investors who generate better returns irrespective of the market conditions. So, asset allocation is one such factor, aiding such returns, and investing at the bottom is another. But how do we know which is the bottom and from where should we start investing? So now let's just examine that, right? Again, it is very futile to time the market. Only thing is like if you are having excess money during the downturn, so how the returns can be, how were the returns in the past is what we are actually examining. So this is the Sensex data. It is available from 1986, and we have calculated the rolling returns for 1, 3, 5, 7, and 10 years, and then looked at the minimum, median, maximum, and the mean returns here. So now let's look at how the market has bounced back after correction. So here we considered only corrections, uh, anything over 10%, negative 10% as a correction. And the time horizon is at least like one year time horizons is what we have taken. So the number of instances here are like 9,113, right? So so the recent correction from October is not taken into consideration because we are only checking the historic data, how the bounce back has happened. So for this, probably after a year's time, we will be knowing how the bounce back is. So let me explain how the market recovery data here should be, right? So somebody who has invested on 3rd February 1986. So after 1 year's time, that is on 3rd February 1987, her return would have been negative 10.43%. So in case at this point, if somebody has invested and waited for one more year, that would have been negative 22%. And if the same person waited for the 3 years, then it would have been like 6.91. For 5 years, it would have been an annualized return of 32%. Same for 7 years. And for 10 years, it would have been around 19.5%, right? So if you remember, the median and the maximum returns, the median returns and the mean return and the maximum returns during such time for on a 10-year horizon are like around 11% here. So maximum is around 26%. So in the similar way, we have calculated for all those years where the corrections were there. And if you look at the minimum, median, and the mean, they're significantly higher than the minimum, median, and mean here, right? So only the maximum is something which is similar. But again, the odds for the maximum will be like really very low. Now let's look at the correction ranges. When the correction is between 10% and 20%, 20% and 30%, and over 30%. So in this case, the minimum return after 1 year was like negative 39, around negative 39%, the median around 16%, the mean 21, and the maximum around 1 or 2%. But what are the odds of getting a 10 to 20% correction? So if you are looking at the entire data of 1 year, of the 1 year instances, there are 9,113 instances. So of which there are only 9.35% times where the market has corrected over 10%. And similarly for between 20 to 30%, so there are only 5.63% of the time these things have happened. And for over 30%, this has been around 2.35%. Now, if you look at the minimum and the maximum returns over a 1 year period of time, again, this has reduced. The higher the correction, the bounce backs are a lot more sharper comparatively. If you look at it, so the minimum is around 24% compared to 39% here. And if you look at the similar vein at 30%, the minimum has been around negative 19, negative 20%, we can say. So the median, if you look at the when the corrections are over 30%, the medians are around 70% in a 1 year time. So compare this to the 10 to 20% and 20 to 30%, where it is around 16%. The mean, the maximum would be something like a similar range, but the median is something which will be a lot higher compared to the mean compared to the corrections of 10 to 20% and 20 to 30%. So it's really very important to have to take the odds into consideration. So when we are saying this 9.36%, So only after this 9.36 will the market can go down by 20 to 30%. That means like if you are somebody investing when the market is correcting by 10 to 20%, there is 50% chance that it may go down to 20 to 30% as well. And you have to understand from 20 to 30%, there is another 50% chance it may go down to over 30% correction as well. So that means if it is going from this area to this area, you can expect these are the bounce backs which have happened in the past. And if it is going down from here to here, these are the bounce backs which have happened in the past. Right. So this indicates that the odds to time the market are like really very low in order to get all this stuff, and getting right are like really very low. So, but ideally, an investor should be bold enough to invest during this time, because even if somebody is catching a 10 to 20% kind of correction, his upside is a lot higher compared to the risks, right? The chance of going down is like really very low from 10 to 20% after 10 to 20% kind of correction. So if it has to go down even further, that is the chance is like around 8%. So the chance of going up is like over 90%. Now let's look at the additional return that is alpha created when invested during such times. So these are the Sensex returns. So these are the Sensex returns during the drawdowns, the negative 39% and median and the mean. So after 10 years, these are the annualized returns, right? So after 10 years, the minimum annualized return is at 2.42% compared to 4.37%. Again, you have to understand that this data is from 1986. So if you look at the data from maybe 2005 onwards, the minimum returns will be higher compared to the fixed deposits actually. One reason why this has happened is like before 1990, India was a bit of a closed economy and there were many multiple scams which have happened, and SEBI was not even there before 1990s. And the kind of scams which have happened in 1990s on the stock market are not possible now. So maybe you can expect slightly higher returns. If we move the data from 1986 to 2000 or 2010, so maybe that is the relevant data. That is the more relevant data now, because even the PE multiples we are not comparing with to that era. So in that case, it will be a lot higher. But let's just take the 40-year data and compare, right? So when someone is investing for 10 years, so the during the downturn, the minimum annualized return is around 2.42%, and the alpha it is generating will be around 6.8%. Right? Indicating a very high downside protection when the market is flat or going down for a prolonged period. So that's how it happens during a downturn actually. So, but getting a highs and lows are like very unlikely. These are extreme events. Most likely, most of the investors end up with the median kind of returns. Even if you are looking at the median kind of returns, the 10-year annualized alpha would be around 4.38%. So now let's just couple this with the asset allocation, right? So if someone invests in equity only for goals over 5 years and hybrid funds for goals between 3 to 5 years, here again, 70% of it would be in debt and 30% would be in equity. Typically, this is the composition of a conservative hybrid fund. So that would result in a return of 8.2%, and debt funds for anything less than 3 years. So over last 5-10 years, the fixed deposits, the debt funds have done more than 7%, but conservatively have taken an estimation of 7%. Then if a person moves the funds from equity assets to debt funds or hybrid funds, depending upon the goals and the time horizons, right? So how will the returns pan out? Is what I have tried doing it here. So if you look at it, if somebody has a uh, goal for over 7 years, let's say there is a goal which is there for 7 years. Now this person has put that for 5 years in the equity. That is, so in 1996, this person has invested uh, during 1989 with a horizon of 7 years. So in 1994, this person will be moving these funds into hybrid funds. So what would that return be? So in that case, it is like 32.2%. Compared to the pure Sensex return, that would be around 24.31%. And these dates are one of the major drawdowns which have happened, right? So if you look at it, the 1 year returns, you will observe that if somebody has invested 1 year on 18th January 1995, his return would have been negative 19.54. Somebody has invested on 5th March 2008, his or her return would have been a negative 48.68%. But this is something like if somebody has invested with a goal and by just following the asset allocation, he would have invested in a debt fund. So similarly for year 10, so 3 years before the goal, that person will be moving the funds into hybrid funds, and what would that return be? So what we have done is like we have looked at the median returns which have been generated and then the median alphas which have happened. So over a 10-year period of time, the alpha generated would be around 4.9%. Now, both combined, this 4.9% along with this 4.4%. So that would be around 9.3%. So this is something which the asset allocation and the investment which is done during the drawdown can generate over the next period, 10 years of time. So 10 years over a 10-year period of time, the alpha generated would be around 10 percentage points annualized. So this will be some small part of the portfolio, obviously, because because the person will be investing regularly and he will not be waiting for this specific events to occur to invest. So even if this is captured by around 3 to 4 percentage by around 5 percentage of the portfolio, that will add almost like a 0.5 percentage of additional return compared to index to the portfolio, right? So this video is for educational purpose only. So it is neither a recommendation to buy nor sell the asset class in the discussion. Thank you.